Good evening, ladies and gentlemen. We are back with another show live from London, and we are going to discuss today the tightening of monetary policy in Australia. What are the implications and how this tightening is going to help the journal citizen of Australia, and of course, living in England and United Kingdom. We are also looking that Bank of England is also tightening the monetary policy. They are increasing the interest rates, which will discourage the demand, and the government is not going to throw money in the markets, and even they will try to create a shortage, and things will be really tightened, and this will blow down the inflation in the economy, and things will start getting moved better. The cost of living is expected to be back, and the mortgage, housing, energy, everything with it is gonna be better and better than, of course, what we are struggling nowadays. So for that, we have invited our guest live from Sydney, Australia. Please welcome Imran Ashraf.
Thank you so much, Musa, and good morning, everyone.
Imran, how is the morning in Sydney? Is it hot? Is it cold?
Well, actually, it is. We are in the middle of summer, but from the last few days, this summer is surprisingly more toward the cold side, and we are having temperatures of 21 to 22, and still in some areas you can see that people are wearing their jackets and things like that, which is quite unusual for the Australian summer, and especially at this time of the year in the beginning of January. But I think once again it might be a climate effect or rains effect that it's more fresh.
That's amazing. The people from Canada, Russia, or Europe who is into snow and in heavy cold temperatures. I mean, I think Singapore, Australia, that side of the world is a great destination to explore. And I guess that you will be facing a lot of tourism in your country.
Yes, especially, as you know, that New Year Eve is one of quite a big event in Australia, and especially in Sydney. There is a report saying that this year, because they have celebrated the New Year Eve after the COVID-19 and removal of the restrictions of the COVID-19, and a lot of people from overseas has came through. There were a report saying around 1 million people on that night in the Sydney city. So it is definitely a big, tourism is a big part, and especially the cruise industry is back on track. We have seen in the report in the last few years that due to the due to the idle stand of the cruise industry in Australia, the industries, those who were related with the cruise and ship industry, were actually missing out the big share out of $10 billion annual industry. So it is the food and beverage industry, the suppliers, the different vendors, the transport, and people, those who got their jobs in the cruise industry. So thank God that thing is coming back to Sydney as well. And we have seen in the quite recent few weeks 2 big cruises being docked at the Sydney Harbour. So once again, quite a bit economic activities going on at the moment.
That's amazing. I guess this tourism always add a lot of $1 million in the economy as your GDP, and Australia is quite attractive destination, and you have very nice diverse wildlife and a commercial life and a cruise life, and you have so many interesting things, and you're a lucky guy living in such a nice weather where people are suffering from cold. So with this weather, I guess I should give you the mic, and people are really excited to listen that how Australia is handling its monitoring policy and how you look into What's your perspective? Please go ahead.
Thank you, Musa. Today's topic, once again, is quite interesting. And I think it's one of the things that everybody is having discussion on these days. The tightening of the monetary policy, of course, it's a little bit economic jargon term, but in common saying, it is increasing interest rate, and it has an impact on slowing of the economy. So in general, I think, Musa, what we really need to understand here, we need to have a little bit understanding for our general audience. What is the cash rate, reserve rate, and how does it work, and why RBA is using this conventional monetary policy tool to control different events which is happening into the economy at the moment, especially in Australian economy. When we look toward the Australian economy, that the interest rate was pretty stable. After GFC, we haven't witnessed any increase in the interest rate. Interest rate was continuously on the downward trend because at that time, the government were in the mode of expansionary fiscal policy, and similarly, the Reserve Bank of Australia, through its resolution and board meeting, has the responsibility of the better living standards and better social life for the Australian public and people. So the interest rate was pretty stable and always on the downward trend. However, once in a generational event factor of pandemic hit in 2019 and then 2020, that has changed the different things in the world horizon in terms of the demand and supply, in terms of the labor shortages, in terms of the COVID restrictions, mobility of the people from one place to another place. All these different factors has given birth to the rising inflation. And when the rising inflation hits, it will have its own impacts, and it will have its own repercussions as well. And at the same time, when Reserve Bank have witnessed for quite a long time that the inflation is actually getting out of its targeted band control of 2 to 3%, then they actually have used the conventional tool of monetary policy to tighten the monetary policy so that they can control that thing. So by tightening the monetary policy, the Reserve Bank has actually lifted the cash reserve, cash rate targets. And in that way, they can control the people's spending. They can make the accessibility of the liquidity in the market more difficult and more inaccessible. And in that way, the spending habits of the people will change, and it will help them to reduce the inflation factor. Now, before coming straight into that one, I would like to give a demonstration how the cash rate or the in Australian market will work. There is a policy interest rate corridor always there, which is the difference between the cash rate or what we can say our Reserve Bank of Australia deposit rate and Reserve Bank of Australia lending rate. So cash rate is the rate where actually different commercial bank can borrow the money from one another and pay interest on that one. And how does it work, Musa? In Australia, and I'm pretty sure in UK as well, the same sort of economic system will work. When we look toward the financial system in Australia, Reserve Bank is the main body who can actually hold the ES accounts, exchange accounts of the different commercial banks. And similarly, all the payments which are coming to these banks for the consumers through of the government, they can come through the reserve banks. So ES accounts is actually the account which commercial banks have with the reserve banks. And for example, I can give you a very common example. If in today's market, one consumer buys something online and they make a payment online through their account for that product, so that payment will go to the seller's account through a banking channel. How does it work? The buyer's payment will be debited from his account by his bank, and actually go into that ES account of the bank, which is hold with the Reserve Bank. And that ES account of the buyer's bank will adjust that payment on behalf of the buyer to the ES account of the seller bank, which is again with the Reserve Bank. So these ES accounts of different commercial banks will adjust their payments of debit and credit, and in that way, these funds will be transferred from the buyer to the seller account, from the seller to buyer, the product will reach. So in saying that, whenever the ES account of one bank will go into negative zone, or they have less money in the ES account as compared to the payments they have to make to the other bank ES account, then they will borrow money from the Reserve Bank. And when they borrow the money from the Reserve Bank, that is the RBA lending rate. That's where the cash rate lending rate factor jumps in, and that's where the commercial bank borrow the money from on that cash rate margin. And similarly, when some of the Reserve Bank ES account has surplus fund, they can actually lend that money to some other bank ES account through Reserve Bank again, and that's where the RBA deposit rate jumps in. And similarly, if, for example, in Australian financial system, people get money from the government, for example, just as example, they get money for the social benefits, those who are living under the poverty line or a low wage threshold band, that payments comes through the government to RBA, and they goes into different bank ES accounts, and then the recipient will get the payment in their bank account through their bank ES account. So that's how the whole system will work. Now, coming toward the conventional tool of the monetary policy, yes, of course, RBA has this conventional tool of monetary policy to increase the cash reserve rate when they see that the inflation band is going high in the market. And the reason behind this, increasing the cash reserve rate, the lending rate for the banks will go up as well. And when this, the lending rate for the banks between different banks to banks will go up, they will increase their lending rates for the customers as well. And when the interest rate for the customers gone up, then interest rate on consumers or people's mortgages, household mortgages, business borrowing, day-to-day transaction will also go up. When the interest rate will go up, the accessibility of the money or liquidity is more expensive. And in terms of saying that when accessibility is more expensive, people will have less access to the liquid or cash flow. And in that way, the Reserve Bank will target to curtail some pressure on inflation. And this is exactly what has happened. By the end of November 2022, where we have witnessed that inflation has gone up to 7.71%. And RBI is predicting it's going to go, before it's start to come down, it's going to reach to the height of 7.75% by the end of December 2022. And then after that, it will have some impacts of the recent interest rate hikes and tightening of the monetary policy. And then we can start looking some sort of downward trend in the inflation pattern as well. So definitely, Reserve Bank is using its conventional tool of increasing interest rate, and the aim is to reduce the inflation within the targeted band of 2 to 3%. Because one very important thing here needs to understand that high inflation is because of the extra and overheat in the economy. And if RBA does not take this decisive step of conventional monetary policy, then it will have a more negative impact. In general, a lot of people, as a common sense, say, why RBA is increasing the interest rate when there is always already a high inflation, people are struggling, household budget is already under stress. Why RBA is putting more pressure and putting more stress on the household budget by increasing the interest rate? I think this is a very important factor and important element for the common people to understand that increasing interest rate in long term will have more economic benefit by not increasing the interest rate, because in long term high inflation will have a more damaging impact on the economy. Because of that high inflation and extra heat in the economy, it will have a severe impact on the people purchasing power, people spending habits in the long term, and which eventually lead to more unemployment and more contraction in the economy, or possibly towards a recession as well. However, the tightening of the monetary policy by using the conventional tool of high interest rates will have a strict effect for the short term or in the coming future, but its result will be more beneficial for the economy in the coming terms. Now, in saying, Musa, coming toward the Australian economy, yes, Reserve Bank has tightening the interest rate. We have seen from last year, February 2022, that interest rate has started to go up, and the interest rate factor was sitting at 0.1% or 10 basis point, which is today sitting at 3.1% or 310 basis point. It is quite significant high from that level, and the aim of the Reserve Bank was to curtail the problem of the inflation, but the economy is actually pushing that monetary policy tool at the moment. In my understanding, there are few factors and few reasons which is not which is acting as a hurdle in the way of Reserve Bank outcome by this tightening of the monetary policy. I can give you an example of the one segment of the market as a labor market. There is a strong demand of labor, and there is a strong shortage of labor in the Australian economy at the moment, especially when we look toward the recent few years after COVID-19. The retail and recreational and tourism industry is really struggling with the shortage of labor at the moment. We were discussing some things in the beginning of our program, like cruise industry and the tourism industry. Still, these industries are struggling with labor in finding the staff, and this is once again as per the National Australia Bank survey, that people are in those industries are seriously having a labor shortage problems as well. However, what we can witness from the fact that increase in the interest rate or tightening of the monetary policy by the Reserve Bank of Australia has started to deliver some impact on the economy, as an Australian economy is showing some sign of slowing down. If you look toward the September quarter report, the economic growth in Australia is 0.6%, which is out of the total of 5.6% for the whole year. So that quarter in particular shows a real slowdown, which is showing that the people's spending habits is going down. Obviously, because of the high interest rate, people's savings levels are going down as well. And when we look toward the household saving factors in Australia, once again, as per the National Australia Bank economic survey report, household saving in Australia has gone down to 6.9% in September quarter 2022. And that saving was sitting at 11.2% in March quarter 2022. And once again, that was sitting at 19.4% in September quarter, the same the year before 2022 in September 2021. So there is a significant drop in savings of the general household. And when there is a significant drop in the saving level of the general household, obviously their spending level has gone down as well. And when there is a people spending is going to be contracted, it will definitely have a slow impact on the economy. And that's what we have witnessed in our September quarter. There's only 0.6% growth in the GDP. Now, coming to the factor that one other important thing I would like to mention here, that the current government policies in terms of in line with the Reserve Bank of Australia. They are not doing any cash handouts to the household and to provide any cash relief to the household through the expansionary fiscal policy, which is good in a way because they don't want to act as a counterproductive against the steps taken by the Reserve Bank of Australia aimed to curtail the problem of inflation. Very recent example that government has taken some steps to put some cap pricing on the coal producers so that majority of the power plants in Australia, those who are still based on coal, they will have a cheaper availability of the coal, and similarly in the gas scenario as well, because the aim of the government is to provide relief to the household indirectly through the cheaper energy prices of electricity and the gas. It is much better option rather than putting direct money into the people's account because it is more effective. But it will certainly be more effective as it has been outlined in the Reserve Bank monetary policy. If in the coming years government will spend more money toward the renewable infrastructure development, where we can see that more job and employment opportunities will be created. And in coming years and in coming decades, we will move toward much greener energy options, and we will have less reliant on the coal and these options. So in saying definitely, Reserve Bank conventional monetary policy tool of rising the cash reserve rate is into action, and it will have delivered some thing which we can witness as a slight slowdown in the economy. But at the same time, other factors like shortage of labor, increased demand of labor, some areas in the economy is really pushing through that patch of the monetary policy as well. So this is the current scenario at the moment. But I personally think that in the next 2 to 3 months will be more interesting to see and watch, especially by the end of March quarter 2023 and especially the June quarter 2023, when we will start to see some real impact of the tightening of the monetary policy of the Reserve Bank will start reflecting into the market, and we will see some real-term slow in the economy, and this overheated bubble of the inflation will start to squeeze down. Thank you, Musa.
That's amazing. I guess that the way you explained it has a lot of insight for our listeners, and these things are really important to highlight to the general public so they start understanding how the tightening of the monetary policy can impact Australia and how Australia is doing in this way. So with this, I want to thank you for joining us today, and I hope this session will be very, very insightful for all the audience, and I'm looking forward to see you guys in our next episode. Till then, take care of yourself and goodbye.